In that last answer, you mentioned some charitable options. Charitable options may be a charitable remainder trust or a donor advised fund. Oftentimes when we're meeting with clients, we find that they really want to fulfill the charitable intent and be philanthropic, but they're worried about what impact that's going to have on their income and ultimately their legacy. They see it as a seesaw. If you give money to charity, well, then that's less money for myself and my heirs. Can you talk a little bit about some of the strategies where people can be charitable, but still end up having more income from themselves and more money for their heirs?
Well, that sounds a little too good to be true. And you know what Mama said about too good to be true strategies, right?
Right.
But that said, there actually is a strategy, and it's called the Charitable Remainder Trust, where you really can do some good things, not just for the charity, but while at the same time you could do some good things for yourself in the form of income stream and for your family in terms of what we leave to your heirs. So first, let me tackle the easier of the two strategies. The donor advised fund, think about it this way. If you're going to have a very large tax year this year, for whatever reason, you're selling a high gain position asset, you're selling your company, you're just having a really strong income year, and you think that this is a good year to get a deduction. Here's the question I ask. It goes like this. What do you feel you're going to give away to different charities this year? How about next year? Do you have a pattern? Could you tell me what you think in the next 5 years or 8 years? What is the amount that you're going to be donating to charity? Now, not everyone can answer that question, right? But the extent to which you could ballpark it, there's no reason why you can't front load all of those deductions this year. And what I mean by that is you could make a big gift this year. Let's say you're giving away $20,000 a year the next 8 years. You could take $160,000, right? That's 8 years worth of gifts. And you could make a gift today to a donor advised fund of $160,000. Now, get a $160,000 deduction this year, but you don't have to give the charities the money all at once. They stay in a donor advised fund. Nikki's firm invests that money for you. It grows. And then each year you decide, how much do I want to actually give to a physical charity that's on that donor advised fund list? So that's the easy one. It really doesn't cost your heirs anything because this is money that you're going to be gifting anyway. So that's the donor advised. The only other thing I would add to that, not to get too in the weeds, but you're limited to 30% of adjusted gross income each year. That's the maximum amount you could deduct. So every $100,000 of income, you can get a $30,000 donor advised fund deduction. If you don't qualify for the full deduction, you get to carry forward the unused amount for 5 years. Now we get into the Charitable Remainder Trust, and I think Michelle created a slide for this one.
I did. Let me share that quick. We find it's easier to follow along when we're talking numbers.
And here we're starting out with an asset that has a very low cost basis. This is an asset that maybe was purchased many years ago, and it's currently valued at $1 million. But way back when, you paid maybe a couple of $100,000 and you've depreciated it, where the cost basis is now $100,000. So there's $900,000 of gain embedded. Now, if you had to pay a tax on that $900,000 of gain, it would be about $200,000, give or take. That would leave you, after you pay the $200,000, that would leave you with $800,000. And if you were to invest that $800,000 at a hypothetical 5%, you'd end up with $40,000 a year in income that's taxable. After tax, again, hypothetical, $28,500 a year. I'm sorry, $28,000 a year of net after-tax income from the net proceeds of the sale. Okay, pretty simple math, and this is an oversimplification. But what if we took that $1 million asset with the $100,000 basis and gifted it to a charitable remainder trust? Well, the first thing you need to know is, what does that mean? A charitable remainder trust, but that's a vehicle that can pay you income for life, and then when you die, what's left goes to charity. Well, how much income? It depends on how old you are, because we look at your life expectancy. but we can maximize your the amount of income coming back to you. And what would end up leaving to the charity would be about a minimum of 10%. If the charity is going to get less than 10%, it fails the IRS rule. So in essence, you move the $1 million, now you sell the asset, and it nets you the full $1 million. There is no capital gains tax. Now you might have some closing costs, but at the end of the day, you got something close to $1 million to invest now. And again, if you invest that at 5%, that gives you a $50,000 income, assuming 5% of $1 million, because remember, you paid no tax, and that'll net you $35,000 a year in income. So there's a savings in income. There's actually an arbitrage. So the difference between 35 and 28, there's 7,000 more income coming to you. If you took some of that 7,000 and bought a life insurance policy for your heirs, well, then that's your have your cake and eat it answer, right, Michelle? It may sound too good to be true, but you're getting a higher income stream. The charity is getting a good amount of money at the end of at your death, but your kids are not disinherited. The life insurance is what we call a makeup provision.
So
Does that
Jerry,
make sense?
yeah, Jerry, just a quick question, Mickey. So what's the disadvantage of a CRT?
Well, the disadvantage of the CRT, so you still control the asset. You could be the trustee, but you cannot take all of that money, the principal, and buy a boat with it. You can't use it for personal things. You could take the income that it pays you and buy what you want with it, and you control how it's invested, but that principal is no longer available for you to spend on personal use items. You cannot run a business from within that trust. You can't buy real estate and live in it. So you're giving up some level of control over the portfolio, but you can invest it with whatever risk profile that you feel you're comfortable with.
Yeah, and just to add to that, that's where you're getting it out of your estate. So if you have an estate tax problem in the future, an estate tax issue, this is a way to get some money out of the estate, but still utilize the income off of it. So thank you.
Great point, Michelle. And the insurance would be also purchased and held out of your estate.
Absolutely. All about reducing the taxes, which is closing that first section